Meantime, the U.S. bond yield curve has inverted. Our next guest says that the S&P 500 could fall up to 40% because of it. Joining us now, Crescat Capital global macro analyst Octavio Costa. Tavi, great to have you on the show.
Hi, thank you, Jackie.
Talk to me a little bit more about the implications of the yield curve inversion and why you think that it could take such a large toll, basically, on the economy and the markets.
Sure. We put out this research a few weeks ago looking at the percentage of yield curve inversions in the U.S. So it's essentially looking at 44 possible combinations of spreads between all the yield curve inversion from 30-year yields, 10-year yields, all the way to overnight rates. And the percentage of inversions is truly concerning. We think that if that number shot up to 60% in the last trading days or so, and almost double since we first put this chart out a few weeks ago. And we think that investors are essentially not looking at the markets properly when thinking that we're going to see another soft landing scenario, when we think it's actually when the Fed actually pauses its rate hike cycle. But that's not what the credit markets are telling us. If you look at the credit markets, they're pricing in what we think it's an inevitable recession in the near term. So if you look at essentially, it's actually a global phenomenon. So the yield curve inversion is a problem that you see in Canada and Hong Kong. Canada and Hong Kong is close to 65% today. So we think that global stocks in general are actually neglecting some major bearish macro signals that we see all lining up today. With markets getting a little more wobbly here recently, we think this is actually probably the start of the beginning of the second leg of the bear market here pretty soon.
Tavi, I'm going to push back just a little bit on this because even though we've seen the yield curve inversion in the past indicate that a recession could be coming or be imminent, a lot of analysts this time around are saying not so fast. That may not necessarily be the case here. The inversion may not A, last that long, and B, even if it does and we do start to enter a recession mode, it won't be as severe as we've seen in years past.
That's a good point. In 2006, we saw kind of a fake signal, really. And I think that if you really look into what happened during the time, when the percentage of inversions was rising, was right at the time when the housing market in the U.S. actually peaked. And there are actually bombs setting off globally in financial markets. If you look a little deeper, home builders and mortgage stocks are actually selling off and falling apart significantly at the time. And we think that essentially, if you look, we just think that, I'm sorry, Jack, I forgot what I was going to say.
That's okay. Take your time. No, you were talking about the recession, the housing market, that the conditions were different.
Yeah, well, if you look at the 3-month versus 10-year yields, essentially the spread between the two have got a lot of attention recently. And it's important to look at that, rightly so. However, it seems to me that the spread between the two inverted. It looks a lot like the 2000 and 1973 market tops. And during that period, the bear market started first. And then after that, 5 to 6 months later, we had the inversion. There was a significant inversion in the spreads. And essentially, that's kind of what we're seeing today. We had a bear market that we think it started in September of 2018. And then we now, 6 months precisely, we had an inversion again. We think that we're now in a bear market rally, and it's playing out very similarly to those times, actually.
All right, Tavi Costa, great to see you. Thanks for joining us. And we certainly are going to watch the yield curve inversion very carefully because investors definitely have had it on the radar, and they're worried about it. They're nervous for sure. Great to see you. Thank you.
Thank you, Jack.